Solomon Fadun, Risk Management of Everything Channel, presents Key Risk Indicators, KRIs. The meaning, importance, types, and roles of key risk indicators, KRIs, in business organizations. Welcome to the Risk Management of Everything channel. On this channel, you will see videos on risk management and the application of risk management to diverse areas and sectors. If you are new here, make sure to subscribe to our channel and press the notification button so you can be notified when we upload new videos. Thank you. This video discusses key risk indicators, KRIs. In this video, you will understand the meaning of key risk indicators, KRIs, business continuity metrics, characteristics of good KRIs, purpose and importance of KRIs, types of KRIs, KRIs selection approach, identifying KRIs, examples of KRIs, quantitative and qualitative KRIs, critical aspects of KRIs, top KRI categories for financial institutions, roles of KRIs in identifying emerging risks, differences between KRIs and key performance indicators, KPIs. Common types of indicators of KRIs and KPIs, quantitative versus qualitative KRIs and KPIs, steps for designing a KRI, how to develop KRIs to improve a business performance, how to use and monitor KRIs effectively, challenges of creating and measuring KRIs, roles of technology in measuring and managing KRIs, and the importance of key risk indicators in strategic planning. Now, let us start. Key risk indicators. Key risk indicators are metrics that predict potential risks that can negatively impact businesses. Key risk indicators, KRIs, measure how risky certain activities impact business objectives. They provide early warning signals when risks, both strategic and operational, move in a direction that may prevent the achievement of KPIs. A key risk indicator, KRI, measures the likelihood that an event's combined probability and consequences will exceed the organization's risk appetite and negatively impact its success. Key risk indicators, KRIs, are critical predictors of unfavorable events that can adversely affect organizations. They monitor changes in the levels of risk exposure and contribute to the early warning signs that enable organizations to report risks, prevent crises and mitigate them in time. Key risk indicators, KRIs, are an excellent way for businesses to keep track of issues and opportunities. KRIs and other risk environment-related data, including loss events, assessment outcomes, and business-related issues, offer considerable insights into the weaknesses within the risk and control environments. KRIs act as metrics of changes in an organization's risk profile, but given the changing risk landscape, simply establishing them within the corporate protocol may not be enough. They provide a way to quantify and monitor each risk. Think of them as change-related metrics that act as an early warning risk detection system to help companies effectively monitor, manage and mitigate risks. KRIs provide insight into the weaknesses in a company's risk, control environment and processes to develop a risk assessment plan to fortify the organization. Key risk indicators, KRIs, are valuable tools for business lines managers, senior management and boards to help monitor the level of risk-taking in an activity or an organization. To business lines managers, they may help to signal a change in the level of risk exposure associated with specific processes and activities. To senior management, they reflect the level of risk exposure, use or stretch of resources, and critical controls effectiveness. The board can indicate whether the firm operates within the set risk appetite. Finally, for modelers, key risk indicators are a natural way of including the fourth element of the advanced measurement approach, AMA, and the business environment and internal control factors, BICF, into operational risk capital. Key risk indicators, KRIs, are essential in enterprise risk management programs. Businesses can benefit immensely from identifying and using KRIs. Benefits of using KRIs include 1. Advance notice of potential risks that could damage the organization. 2. Provide insight into possible weaknesses in an organization's monitoring and control tools. 3. Support risk assessments. KRIs help add more detail and information to risk assessments, making them more reliable and informative to management. 4. Proactive management of emerging risks. KRIs allow for the proactive identification of emerging threats by creating an informative framework to scan for what is on the horizon. 5. Tolerance levels and thresholds. KRIs detail at what level of risk is considered necessary for attention or direct intervention. 6. Trending KRIs. KRIs can help management track trends in risks to the organization. This will help identify areas where huge investments may be needed, and opportunities exist. Business continuity metrics. Metrics measure the completion of tasks within a business continuity program and show resilience capabilities. There are 2 business continuity metrics: 1, activity and compliance metrics, and 2, product and service metrics. Let us discuss these 2 metrics. 1. Activity and compliance metrics. Activity and compliance metrics answer the question, are we doing the right things to prepare? These are straightforward metrics and usually ensure that program deliverables and outcomes are on track and consistent with expectations. Activity and compliance metrics are also known as key performance indicators, KPIs. Activity and compliance metrics track the completion of key deliverables in the business continuity life cycle. These metrics can include the number of business impact analyses, BIAs, updated, the number of business continuity plans updated, or the number of exercises completed. By tracking the completion of activities, the program manager can monitor the company's progress based on regulatory standards to determine if the business continuity planning process is effective. The typical audience for activity and compliance metrics are participants in the business continuity planning process, the program sponsor, and the business continuity steering committee. 2. Product and service metrics. Product and service metrics answer the question, is the company adequately prepared to excel in its sector or industry? These metrics help program leadership focus on evaluating the company's ability to continue or recover time-sensitive activities and resources that contribute to the delivery of products and services. Product and service metrics are also known as key risk indicators, KRIs. This video discusses key risk indicators, hence product and service metrics are essential in discussing key risk indicators. Product and service metrics are critical in summarizing for executive leadership the organization's ability to continue or recover products and services and communicating program gaps and risks. A program manager must show the organization's confidence in continuity and recovery capabilities to inform the leadership capabilities. Having metrics that convey current capabilities concerning risk tolerance allows executives to prioritize risk mitigation for the program's future. Metrics help to measure the completion of business tasks and resilience capabilities. The typical audience for product and service metrics is the executive leadership team, including the board of directors, the program sponsor, and the business continuity steering committee. Business continuity checklists can be used to determine the appropriate business continuity metrics for a business. Kindly see my video on business continuity management to learn about business continuity. Let us discuss the characteristics of good key risk indicators. Characteristics of good key risk indicators. When developing a KRI, knowledge of the organization and how it operates, including understanding the potential risks, threats and vulnerabilities it faces, are the essential starting points. Without an understanding of the company, it is difficult to identify where it may be at risk. KRIs are measurable. KRIs can be measured using percentages and numeric indices. They are predictable and often used as early warning signals while tracking trends over time. Since they offer helpful insights about potential risks that may impact organizational achievements and objectives, KRIs are informative and act as a catalyst for decision-making. Considering the importance of KRIs, they must be identified and managed effectively. Internal and external risks are then mapped to critical operational aspects of the firm to identify how those key attributes might be disrupted. Thus, characteristics of a reasonable and measurable KRI include the following. 1. Details on the people, processes, technologies, facilities and other corporate attributes most important to the organization's continued operation and success. 2. Identification of risks, threats, and vulnerabilities the organization faces based on their likelihood of occurring, their operational and financial impact on the firm, and the firm's ability to mitigate the event. 3. Ranking the business attributes in terms of their criticality to the firm. 4. Ranking of risks, threats and vulnerabilities in terms of their potential harm to the firm. 5. Linking the critical business attributes to the most significant risks to identify those issues of greatest concern to the organization. 6. Metrics to identify when and how an identified risk becomes a serious threat to critical attributes of the organization. 7. An ongoing process of reviewing KRIs and their metrics to identify any changes that require management review and possible action, and 8. Approval of KRIs by the company's senior management. Furthermore, a sound key risk indicator, KRIs, should be 1. Specific. Key risk indicators, KRIs, must be accurate and precise in their measurement. For each KRI, there must be a lower bound, trigger limit, and an upper bound, alert limit, established, which allows management to detect the potential for increased risk exposure in day-to-day operations. 2. Relevant. Key risk indicators, KRIs, must be relevant to monitored risks. Good KRIs help companies identify, quantify, monitor, or manage risks directly applicable to business objectives. A good KRI relates directly to business initiatives and allows the company to keep track of its crucial operational risk management activities. Wasting time on irrelevancies is something good KRIs help a company to avoid. 3. Measurable. Key risk indicators, KRIs, should be measured regularly to ensure a high level of certainty and effective decision-making. KRIs may be qualitative if no quantitative measures exist. 4. Predictive. Good KRIs help to predict future problems. Good KRIs can predict future issues that management can preemptively address. Any KRI that doesn't help with early warnings about future risks, whether directly or indirectly, is not where the company wants to focus its risk management time and effort. With good KRIs, the company can identify its potential risks before they have an effect and create adequate risk assessment and management plans. This enables the company to respond quickly to emerging issues, keeping the company's risk exposure as minimal as possible. 5. Provide opportunities. It's important to note that KRIs do not only signal threats to a company's objectives, strategy, and overall existence. They also identify potential opportunities that abound from proper risk management plan implementations. Metrics provide information on where these opportunities are and the necessary actions required to exploit them. 6. Efficient. Good KRIs should be reasonably simple to collect and document at a reasonable cost. They shouldn't consume too many financial or operational resources since they serve as metrics collected from internal and external sources, providing risk-related information about a company's regular day-to-day activities. 7. Comparable. KRIs track a company's risk exposure over time. Comparable data can reveal how the company's risk exposure has evolved, giving clues about the effectiveness of the company's risk management operations. Hence, KRIs should be consistent and generate data that can be compared periodically. 8. Alert and trigger limits. Key risk indicators, KRIs, trigger an alert based on set limits. Alert limits are quantified as a significant shift in risk to tremendous potential for an adverse risk event, requiring immediate action to report, escalate, and develop remediation. Consequently, KRI's trigger constitutes a shift in risk to a level beyond management's expectations, requiring monitoring and identifying risk drivers and possible control failures. Purpose and importance of key risk indicators. Without identifying key risk indicators, KRIs, an organization is likely subject to events or situations that could significantly damage its business. KRIs are the red flags that ensure these risks are identified in advance and mitigated. In essence, KRIs provide an advanced heads-up that enables companies to manage their risk exposures effectively. Key risk indicators, KRIs, add value to operational risk management by playing an essential role in a company's risk management process. KRIs predict potential risk, especially within high-risk areas and sectors. KRIs can help with the following. 1. Identifying any risk exposure relating to current or emerging risk trends. 2. Assessing and quantifying each risk and its potential impact. 3. Providing perspective through benchmarking. 4. Enabling timely and ongoing risk control and monitoring. 5. Helping leaders and key personnel to receive alerts of possible risks in advance. 6. Ensuring sufficient time to develop appropriate and effective risk responses. And 7. Establishing objectivity within the risk management process. Key risk indicator selection approach. There are two main approaches to selecting key risk indicators, KRIs, top-down and bottom-up. Let us explain these KPI selection approaches. 1. Top-down approach. A top-down approach is the most effective for strategic KRIs. Senior management selects indicators to monitor across the business. They can facilitate the aggregation of risk and management's understanding of common risks impacting strategy and business objectives. 2. Bottom-up approach. The business lines select and monitor relevant indicators within their operational processes. The bottom-up approach ensures critical risks are identified and tracked at a granular level to enable the lines of business to manage risks that are most tangible and relevant. Types of key risk indicators. Generally, there are two primary key risk indicators, KRIs, types, lagging and predictive. 1. Lagging key risk indicators. Lagging KRIs monitor data retrospectively to identify changes in the pattern or trend of risk and activities. These types of KRIs ensure that risk exposures are managed effectively to prevent or reduce further exposure or consequence. 2. Predictive or leading key risk indicators. Predictive or leading KRIs signal changes in the likelihood of a risk event. They are more likely to aid management in taking action before risks materialize. Identifying key risk indicators. A company needs to identify its key risk indicators, KRIs. To identify and develop them, the company's risk management team must follow a careful process in coordination with other parts of the organization. 1. Identify the company's goals and vulnerabilities. As mentioned earlier, a good KRI is relevant to business goals and objectives. A company's business goals should be determined before identifying the firm's key risk indicators, KRIs. This is necessary because KRIs seek to protect and enhance a company's operations and resiliency. Hence, identifying KRIs involves formulating business goals to avoid unnecessary complexities in the risk management process. Once business objectives are determined, identifying the risks and barriers to achieving those goals becomes more manageable. Effective KRIs will address the firm's most critical threats, so identifying these risks at the start of the company's risk management process is an important step. Strategic objectives provide a company with a significant business context to prioritize its risks. They help the company place its risks on a scale of preference and, consequently, keep the organization's KRIs relevant. In short, determining business goals is the foundation for creating its risk management framework. 2. Understanding potential risk exposure. Risk exposure measures potential future losses resulting from a firm's risk exposures. An analysis of the risk exposure for a business will rank risks according to their probability of occurring and potential harm. A company's risk exposure, in turn, helps in determining the organization's risk appetite and the strategies to keep its losses below the set threshold. Risk exposure can be calculated as follows. Risk exposure equals the probability of a risk occurring, multiplied by the total loss of risk occurrence. 3. Establish key risk indicators. Start by focusing on the priority risks. Having prioritized a company's risks based on its business goals and determined how each risk contributes to the firm's overall risk exposure, it is time to establish the indicators. Work with internal experts in the company's operating units to determine a good KRI for each risk. For example, if a significant security risk is loss of customer data, the privacy or IT security teams might recommend tracking failed user logins or password reset requests as KRIs to measure possible cyber attacks. Good KRIs are metrics that are highly relevant to business goals, quantifiable, comparable, and predictive. Any KRI developed can be compared against these attributes, assuring they are actionable enough for effective risk management. The company also need to consider how often indicator data is updated. This is where information through software becomes handy, as they help a company to automate an integral part of its risk assessment workflow. 4. Incorporate a monitoring process for the company's key risk indicators. Once the key risk indicator, KPI, data collection processes have been established, the company needs to create a system or framework to monitor the data collection process. This is necessary to monitor the type and quality of metrics data collected. Using the initial data gathering or risk assessment periods can help solve this. It is also essential to compare the KRI data collected against the company's risk appetite or threshold. When KRI breaches existing risk limits repeatedly, that is a warning sign not to be ignored. Either the company's business practices are too risky, or its KRI was designed poorly. Either way, the company at least know to investigate further. Furthermore, the company should incorporate indicators into ongoing risk management and reporting processes. This should include a protocol to alert appropriate risk managers, business unit managers, and leading team members when the company's risk appetite levels are exceeded or close to being exceeded. Constant monitoring, complemented by respective changes in operational business processes, is where the heart of risk management truly is. Good KRIs help a company to make the most informed and reliable strategic decisions in accomplishing business goals while limiting risks. How key risk indicators work. Two categories exist when discussing the risks that KRIs help monitor and manage: pure and speculative. 1. Pure risks are unavoidable occurrences like death or natural disasters which are out of the company's control. 2. Speculative risks, on the other hand, are voluntary risks that a company undertakes with uncertain outcomes, investments and mergers, for example, or risks arising from introducing new products. When the KRI trends upward in a positive direction, that indicates an increased chance of the risk happening or at least exceeding the company's risk appetite. To push the KRI back down, the company would typically reduce the activities related to that risk. Conversely, when a KRI moves in a downward direction or holds steady, the company's risk appetite remains healthy to take more risks in pursuing its strategic goals. Let us consider examples of key risk indicators. Examples of key risk indicators. Key risk indicators, KRIs, are developed by considering the company's human resources, processes, technology, facilities and other elements critical to its operations. KRIs also provide the measurement points that, if exceeded, could disrupt the business. For example, if an organization specializes in retail sales, a key risk indicator might be the number of customer complaints. An increase in this KRI could indicate that an operational problem needs to be addressed. Risk indicators may be either quantitative or qualitative KRIs. KRIs take on different forms based on the risks they aim to mitigate. Either pure or speculative, risks cut across other areas and elements involved in running and managing a company's business. Here are some examples of KRIs. 1. Technology-based KRIs. The various technology risks involved in running the business, ranging from hardware malfunctions to software failures to cybersecurity issues, are measured based on key risk indicators, KRIs. Technological KRIs remain very significant to companies in the tech space. These KRIs are known as technology-based KRIs or technological KRIs and help the company determine how to manage various risks involved in running the technological aspects of the company's business. Some examples include software crashes and hardware failures or inadequacies. Technological KRIs include mean time to repair, MTTR, mean time between failure, MTBF, and percent difference in MTTR. 2. Financial KRIs. Financial KRIs are metrics that give information about the different events that affect the financial health of a firm. These could include metrics monitoring liquidity, exchange rate volatility, and variance reports measuring actual spending compared to budget. 3. Human resource KRIs. Human resource KRIs measure business risks, including low staff satisfaction, labor shortages, and high staff turnover. They are crucial for service-based companies and human resource departments within companies. 4. Operational KRIs. Operational KRIs measure the impact of risks ranging from failed internal strategy execution processes to ineffective internal management controls. Operational KRIs include system availability, percentage of projects delayed, and assets currently not in use. Quantitative and qualitative key risk indicators. The challenge for an organization is not only to identify which risk indicators should be identified as significant key risks, that is the most important, but also to ensure internal acceptance of its KRIs. Organizations must communicate the risk warning so that everyone in the organization understands its significance and can respond accordingly. There are different types of quantitative and qualitative KRIs. 1. Quantitative KRIs. These focus on provable facts and numerical data based on findings from mathematical models and analysis methods. 2. Qualitative KRIs. These types of KRIs focus on predicting probability-based outcomes to support things like sensitivity analysis. Critical aspects of key risk indicators. Depending on a business or industry's nature, quantitative over qualitative KRIs may be more relevant. Some KRIs may be ranked higher on the priority list, be of more importance than others, and be subject to change based on internal or external environmental factors. Different types of top KRIs are used across various industries and sectors, often referred to as critical aspects of KRIs. Critical aspects of KRIs include financial, human resource, operational, technical and compliance essential elements of business key risk indicators, KRIs. Let us discuss these critical aspects of business KRIs. 1. Financial key risk indicators. The financial key risk indicator is vital in virtually all organizations. Quantitative financial KRIs may be of greater significance to banks and other financial institutions. Some examples of financial KRIs that can link to external environmental factors might include ones that measure an economic downturn or regulatory changes. Internal factors might be changes to strategic goals, budget limitations, or acquisitions. 2. Human resource key risk indicators. A company operates through its personnel or human resources, hence human resources key indicator is essential in business organizations. High staff turnover, low staff satisfaction, labor shortages, or low recruiting conversion rates are some examples of human resource KRIs. Staffing and recruitment firms and human resource departments will likely be interested in using quantitative or qualitative people-based KRIs. 3. Operational key risk indicators. Business operation is vital in an organization, hence operational key risk indicator is essential in business organizations. Companies in all industries can develop operational KRIs. Operational KRIs could measure many things, from failed internal processes to ineffective internal controls. Factors impacting operational KRIs might center around process inefficiencies, leadership changes, or changes to strategic goals. 4. Technological key risk indicators. Many companies rely mainly on communication networks. Businesses increasingly rely on telecommunication to ensure efficient and effective operations, particularly the Internet. Any disruption to telecommunication networks can result in substantial costs, depending on the nature of the business and the mode of customer interaction. Companies that rely heavily on telecommunication are susceptible to several risks, including reputation damage and IT security risk. System failures, security breaches, and denial of service incidents are examples of events that technology-based KRIs measure. Technological key risk indicators impact all industries but can be of greater importance to a technology service provider or a firm that relies on online business portals. Technological risk factors might include increased operational complexity, security issues, protocol changes, and regulations. 5. Compliance key risk indicators. Compliance key risk indicators, KPIs, help businesses unearth compliance framework weaknesses. Companies can track the overall performance of the compliance department and the efficiency of different compliance processes. This visibility allows businesses to detect inefficient processes and improve them appropriately. Compliance KRIs also help companies to put their performance in context by making it easier to compare their performance with their peers. The data generated from compliance violations and corrective actions prove valuable for management. This data can help the organization understand its risk exposure better. Top key risk indicators categories for financial institutions. To enhance your understanding of key risk indicators, let us discuss the top key risk indicator categories for banks and insurance companies. Key risk indicators for banks. 1. Credit key risk indicators. Credit-related key risk indicators, KRIs, top the list for banks because these metrics are highly predictive. Loan defaults have proven to be a significant indicator of how the economy will perform. Bankers are looking at the rate of loan defaults by businesses and individuals in different industries to determine which industries are being hit the worst by the pandemic and which ones will be able to recover quickly. The same is true for loan delinquencies and non-performing loans, indicators that the businesses and other clients in the industry or area are underperforming. The pandemic has impacted industries to a different degree. Businesses that were primarily involved in online commerce have benefited from the pandemic. Initiatives that help people work from home or entertain themselves at home have significantly increased business. The telecommunication and video game industries have witnessed increased turnover. Business meetings, seminars and conferences are increasingly done online, reducing the number of customers in the airline and hospitality industries. Credit-related KRIs help mid-sized banks understand how the pandemic affects the local business community in finer detail. It is critical to get this information for bankers because they have access to the data and can thus be the first to understand the financial standing and the future of the local economies. 2. Operational key risk indicators. Operational key risk indicators, KRIs, were the second most crucial set of KRIs being evaluated by risk and compliance professionals. Bankers were keeping a close watch on fraud-related metrics to ensure compliance during the disruptions to operations. Customer request volume is another vital metric explaining why bank customers now opt for and which ones they avoid. It is important to remember that while the shutdowns experienced worldwide are temporary, the pandemic will change how we conduct business in many ways. Banks are looking at how customers act to determine the safest and most comfortable customer experience for the post-pandemic era. 3. Market key risk indicators. While credit-related key risk indicators, KRIs, are essential to determine how the market will be in the future, market KRIs are beneficial in shedding light on the biggest problems in the global market. Bankers are looking closely at unemployment statistics across the country. High unemployment has a significant effect on the economy. Not only does high unemployment show that businesses are facing lower demand and thus reducing the workforce, but unemployed people also cannot participate in the economy anymore, which makes it harder for the economy to recover. Key risk indicators for insurance companies. Insurance companies also use key indicators to ensure their risks are at a tolerance level. Key risk indicators are especially critical in the insurance sector because the insurance sector principally deals with losses. If there are many losses, the insurance company may have trouble meeting all its financial obligations. Keeping close track of KRIs ensures that this never happens. If the losses are above tolerance levels, key risk indicators provide a warning to insurance companies at an early stage, providing them with the time required to get the funding they need. KRIs are also valuable for the insurance sector because they allow an organization to know its overall leverage in real time. Some organizations manually record KRIs, enabling them to track performance and risks. There is no need to wait for reports compiled manually. Management can look at real-time data generated through key risk indicators. However, the lack of real-time visibility into risks can mean that the business will not know about being in a disadvantaged position until it is too late. Most established insurance businesses, therefore, focus on enhancing their KRI tracking capabilities. Roles of key risk indicators in identifying emerging risks. Given globalization and the post-COVID era, emerging risks impact virtually all businesses and sectors. While government, healthcare, and pharmaceuticals focus on strengthening their pandemic risk assessments, other industries develop risk assessment plans to identify emerging risks within their supply chains, internal controls, and fraud or cybersecurity threats due to remote working conditions. As a powerful tool supporting operational risk management, ORM, KRIs help identify and define risks to ensure that companies understand the relationship between each KRI and potential risks. So, how do KRIs help companies identify these emerging risks? KRIs assist companies with the following. 1. Comparing business objectives and strategy to actual performance to isolate changes. 2. Measuring the effectiveness of processes or projects. And 3. Demonstrating changes in the frequency or impact of a specific risk event. It is worthwhile to emphasize that key performance indicators are also helpful in managing a company's operational risk. Hence, discussing the differences between key risk indicators, KRIs, and key performance indicators, KPIs, is necessary. The difference between key risk indicators, KRIs, and key performance indicators, KPIs. Key risk indicators, KRIs, and key performance indicators, KPIs, are essential and related. Though they are related, they are different. Hence, it is vital to understand the difference between KRIs and KPIs. Both key risk indicators, KRIs, and key performance indicators, KPIs, are essential and related. They work together to provide companies and their leaders with the metrics needed to fortify their businesses. They work hand in hand to create a complete picture for effective and timely decision-making. Key risk indicators, KRIs, are measures and metrics that relate to a specific risk and demonstrate a change in the likelihood or consequence of the risk occurring. Key risk indicators are often confused with key performance indicators, KPIs, which are metrics that help an organization assess progress toward declared goals. KPIs identify and prioritize a company's key objectives and monitor performance against those goals. KPIs look backwards and focus on how thriving companies are achieving their goals. KRIs look toward the future. They assess and manage potential risks to goals. They focus on the likelihood that companies will achieve their plans based on potential risk factors. KRIs are linked to strategic priorities and identify each key goal's current and emerging risks. KRIs also monitor risks and send an early warning when the business is at risk of not achieving its goals. KRIs differ from key performance indicators, KPIs, as they are not concerned with how well something is done, but rather the possibility of future adverse impact. KRIs provide an early warning to identify potential events that may harm the continuity of an activity/project. Both key risk indicators, KRIs, and key performance indicators, KPIs, can be applied to the people, processes and technologies critical to an organization's success. The two terms are functionally the inverse of each other. While they may be separate and distinct for some issues, the creation of one often results in the creation of the other as its complement. Key risk indicators, KRIs, provide metrics regarding risks and their potential impact on business performance. They are an early warning capability for monitoring, analyzing, managing and mitigating key risks. By contrast, KPIs demonstrate how well the organization performs against its goals and objectives, for example, sales, revenues and customer satisfaction. Think of it this way. Key performance indicators, KPIs, answer the question, how are we doing against our goals? While key risk indicators, KRIs, answer the question, what is the likelihood that we might not achieve our goals? Or what might prevent us from achieving our goals? You cannot have one without the other if you want to manage performance and risk effectively. Therefore, integrating KRIs into a company's performance management framework is vital to linking key risk indicators, KRIs, and key performance indicators, KPIs, within the organization. This way, by establishing the right risk indicators for a business to monitor its performance using related KPIs. This is paramount as the company can track performance and risk simultaneously in one streamlined process, thereby aligning the company's risk management process and performance measurement. It is beneficial to highlight the main differences between key risk indicators, KRIs, and key performance indicators, KPIs, based on measures and purposes. 1. A company's management can use a key risk indicator, KRI, to measure the risk associated with an activity. Generally, a KRI indicates the possibility of a future adverse event manifesting itself. On the other hand, a key performance indicator, KPI, measures a performance goal or target to achieve business strategy and objectives. 2. KRI provides, preferably, early warning signals or lagging confirmation when risks, both strategic and operational, move in a direction that may prevent the achievement of KPIs. In contrast, KPI provides directional insight into how the organization is progressing towards strategic objectives or the effectiveness of specific business processes or control objectives. Having explained the differences between key risk indicators, KRIs, and key performance indicators, KPIs, discussing the common types of indicators used for KRIs and KPIs is necessary. Common types of indicators used for key risk indicators and key performance indicators. There are three common types of indicators of both KRIs and KPIs, including risk indicators, control effectiveness indicators, and performance indicators. Let us discuss these three types of indicators. 1. Risk indicators. Risk metrics indicate that an unwanted event is becoming more likely or potentially more impactful. They are typically predictive indicators, providing a warning before risk events unfold, although they can be post-event indicators, signaling when risks have occurred and the magnitude of their impact. They can be causally related, that is associated with a triggering event that precipitates the risk event or correlated with the risk event. 2. Control effectiveness indicators. Control effectiveness indicators are risk indicators that measure and monitor the health of the organization's risk controls. Control indicators aimed at reducing the likelihood that root causes will trigger and lead to risk events, and their subsequent impacts or consequences. The probability and implications may change if these controls are not functioning as expected. As such, these indicators are usually predictive and causally related. Their correlation to the risk event may be lower. Poor controls create the potential for a risky event but may not directly or immediately cause it to materialize. However, they can serve as an effective early warning system. 3. Performance indicators. These are metrics that indicate success or progress towards achieving the desired outcome. Performance indicators are related to organizational market factors, internal and external, which are linked to effects and consequences. Performance indicators help demonstrate the achievement of objectives or as a warning to show when risk events are in the early stages of unfolding. In addition to providing helpful immediate feedback on risks and goals, collecting KPI data in concert with risk ratings and KRI data will build a valuable data set for future strategic planning and predictive analytics. Quantitative versus qualitative key risk indicators and key performance indicators. Key risk indicators, KRIs, and key performance indicators, KPIs, are often used for quantitative risk assessment. A quantitative risk is an approach to risk management that focuses on factual and numerical data, along with mathematical models and analysis methods to reduce bias. A risk practitioner would first build a mathematical model that approximates the various scenarios in which root causes the map to each other, precipitate risk events and affect desired objectives. An example might be how changing interest rates are managed by hedging strategies and ultimately affect investment returns. Quantitative models can be computerized and simulated repeatedly, for example Monte Carlo simulation, to predict probability-based outcomes, such as the probability of achieving different investment returns. Numerically based KRIs and KPIs can play a valuable role in these models, adjusting them based on real-time values for assumptions and outcomes. The power of these models is their ability to support sensitivity analysis as different inputs and extremes are modeled. As a result, KRIs and KPIs have become a core component of operational risk programs, typically quantitative-based. Steps for designing a key risk indicator. Here are the steps for designing a key risk indicator. 1. Identify the KRIs, list existing metrics and classify them according to historical performance and predictability. After doing this, determine where the voids are according to those metrics. You probably have a lot fewer from the second category. 2. Select them, choose the KRIs that meet the above conditions, that is, measurable, comparable and effective. Make sure that the chosen ones help identify the event's root causes. 3. Determine the triggers, establish what kind of actions can trigger a threat and create an action plan to deal with it. 4. Monitor them. After creating the list of KRIs, you should continue monitoring and assessing your performance. Having explained the steps for designing a key risk indicator, let us discuss how to develop key risk indicators to improve business performance. How to develop key risk indicators to improve a company's performance. Performance appraisal is necessary to ensure that goals and milestones are achieved. When looking at their daily dashboard, leaders across the business expect to see the information that tells them the current state of things, including KRIs. When KRIs fall outside of thresholds, they alert the company's management that there is an increased potential for risk exposure. But KRIs are only helpful when they are developed using a sound approach. Here are the ways of improving business performance through key performance indicators. 1. Identify the company's risk exposures. Before establishing KRIs, it is necessary to understand the company's goals and any vulnerabilities that can cause risk. Effective enterprise risk management relies on identifying the most significant risks within and outside the company's control. A business's most significant risks consist of risks with the highest impact and the highest chance of occurring. 2. Establish the company's key performance indicators. If the company has already established key performance indicators, KPIs, these can create KRIs. Why? The KPIs will already make sense and provide the underlying information, reducing the time spent monitoring and the needed resources. The KPIs transferred to KRIs must be relevant, timely, measurable, and make sense. If the KPIs are outdated or no longer applicable, they should not be used. 3. Establish the company's major processes. Since KRIs are developed by each department, it is a solid process for creating, assessing, monitoring, and reporting them to the appropriate individuals who need to address the situation. The following best practices can help a business to streamline the process of developing key risk indicators. 1. When identifying KRIs, involve all relevant stakeholders from the start. 2. Gain stakeholder buy-in, so everyone is on the same page and vested in the success. 3. Ensure all information about KRIs and the process are accessible to all stakeholders. 4. Create a central point of contact to whom stakeholders can go to get support. And 5. Keeping stakeholders updated regularly. How to use and monitor key risk indicators effectively. Risk management and audit professionals are pivotal in ensuring the right metrics are in place to reduce risk exposure. Key risk indicators, KRIs, should be linked to a KPI and a strategic goal and should be prioritized to keep the focus on critical risks. It is also vital for KRIs to be continually monitored and tracked regularly, although the frequency will depend on the type of KRI. Effectively using KRIs also relies on having the right risk management platform. Challenges of creating and measuring key risk indicators. It is not enough to simply create key risk indicators, KRIs, and walk away. KRIs must be monitored and reviewed regularly to identify any situational changes that indicate a possible change in the business and risk/threat levels. The company must identify and initiate remedial action to ensure its KRIs are relevant and updated. Challenges associated with developing KRIs arise from an organization's inability to do the following. 1. Obtain accurate information about the organization that can be used to pinpoint mission-critical activities. 2. Identify risks, threats and vulnerabilities and then quantify them by likelihood, severity and impact. 3. Secure senior management support for the use of KRIs as part of an enterprise risk management program. 4. Realistically critical link business attributes to the most likely risk scenarios. 5. Create metrics that are both measurable and understandable to senior management, for example, presenting KRIs using a dashboard. 6. Establish an ongoing activity to monitor, measure and analyze any changes in metrics, and 7. Establish response actions to take if deviations to KRI metrics occur. While KRIs help organizations to combat risks and adversities, there are some reasons why KRI monitoring fails to deliver business benefits, including 1. Difficulty in identifying KRIs for all risks. 2. Insufficient focus on the causes of the risks. 3. Failure to automate the collection of KRI values. 4. Not using existing KPIs in conjunction with KRIs. And 5. Not associating actions with thresholds. But for each of these challenges, there are remedial recommendations. Organizations should start with the key risks and then expand. They should assign KRIs against each cause. If possible, all KRIs should be automated to prevent them from becoming stale. The company's KRIs should be aligned with its KPIs to ensure sound risk forecasting and an effective risk management process. Lastly, associating actions with thresholds goes a long way in synchronizing appropriate thinking when defining points. The implication is that a company's KRIs can be enhanced using suitable technology. Hence, the need to discuss the roles of technology in measuring and managing key risk indicators. Roles of technology in measuring and managing key risk indicators. Given the advances made by technology today, it is imperative to leverage it to look at different indicators in the context of the risk data collated or an organization. Suppose the organization already uses a risk management system. In that case, the company already has risk and control assessment data to ensure that issues data can be effectively combined using the existing KRIs. Technology improves the measurement of different risk categories, metrics, and occurrences. For example, reporting and dashboards make it easy to see critical areas for analyses, thresholds, breached or otherwise. Technology helps establish thresholds, such as green, amber and red, that represent rising and declining indicators for critical and non-critical indicators. Automating KRIs to give them longer lives and tracking remedial action. When KRIs are escalated and tracked for follow-up, are some options available when technology is harnessed appropriately. Technology also makes it easier to explain to regulators the activity undertaken and the situations mandated because it leaves an audit trail that reveals these details. Risk management strategies should be established for specific, measurable, relevant and timely actions and responsibilities. Understanding KRI standards and measurement specifications are paramount to ensure a sound enterprise risk management framework. Furthermore, it is necessary to determine the organization's analytics providers and the metrics consumers through various tools and resources. One of the most significant benefits of leveraging technology to manage KRIs is that it reduces manual processing, which can be time-consuming and cumbersome. Technology supports manual and automated data collation methods, enables the easy definition of thresholds, and tracks issues and actions for breaches. It provides a single interface to define KRI, KPI, key control indicators, KCI, and risk appetites. It is possible to track metrics for causes, consequences and risks, which are easily accessible to personnel studying these within the organization. Having explained the roles of technology in measuring and managing key risk indicators, let us discuss the importance of KPIs in strategic planning. Importance of key risk indicators in strategic planning. Do you know what the future holds for your company? While you cannot predict exactly what might happen, an excellent key risk indicator, KRI, program will give the company an insight into likely events to reduce risks and take advantage of unexpected opportunities. Key risk indicators, KRIs, are essential in strategic planning. Strategic planning focuses on long-term planning, and KRIs are imperative to ensure sound strategic planning. A robust risk management program highlights an organization's risks and can reduce their impact or help avert them altogether. This is only possible if one can peer into the future to see what risks and opportunities may be on the horizon. But how? Key risk indicators, KRIs, are metrics that the company can use to help anticipate trends that may indicate future risk. Here are reasons why KRIs are essential in a company's strategic planning. 1. Key risk indicators, KRIs, are forward-looking. The most important thing to understand about key risk indicators, KRIs, is that they are leading indicators of potential risk. This is in contrast to key performance indicators, KPIs, which measure how well something has been done in the past. While KPIs may help assess a company's risks, they are not designed to be leading risk indicators. KPIs are generally historical, for example, how the company performed last quarter. 2. Key risk indicators, KRIs, are based on strategy. It is essential to understand the strategic goals and objectives of the company to develop the most effective key risk indicators. The company also need to understand the vital risks affecting the company's ability to achieve those goals and objectives. Understanding historical performance trends are also critical in establishing effective KRIs, assuming that ease of use is an important market differentiator for the company's products. One potential KRI could be customer service volume. An uptick in calls, particularly if it exceeds a pre-established threshold, could indicate a looming problem. 3. Key risk indicators, KRIs, are measurable. One advantage of KRIs is that they take emotion out of the equation. By establishing quantitative metrics and setting thresholds for action, senior managers can respond to risks appropriately as they arise, rather than over or underreacting based on gut feelings. This also means that KRIs should be based on readily available data. At the outset of developing a KRI program, a company should consider internal and external data availability and limitations, staffing implications, and system requirements necessary to keep track of frequently voluminous data. The company's management should review the metrics used to monitor risk and performance and the policy limits that would trigger corrective action. 4. Key risk indicators, KRIs, are actionable. Finally, the company must have an action plan should a KRI reach or exceed established tolerances. This has the additional benefit of empowering managers and employees to recognize and mitigate risk. KRIs are central to promoting an organization's ownership and awareness of risks. Identifying new and emerging risks, reporting to senior management and the board of directors, and improving overall performance are just a few key roles that KRIs play in managing risk throughout the organization. Lastly, let us discuss risk management metrics and key risk indicators. Risk management metrics and key risk indicators. Companies, public and private, boards and CEOs increasingly depend on operational risk management metrics. These include key risk indicators, KRIs, at the business process level, which have the proven capability to be escalated as necessary. Internal audit is essential to validate the most timely and significant risks, especially those that impact the achievement of the organization's strategic objectives and key performance indicators, KPIs. Hence, the need to address the question, why are risk metrics and key risk indicators, KRIs, essential to ensure sound risk management practices? Risk metrics and key risk indicators are fundamental ways to measure effectiveness. This is because risk managers must prove they are meeting the expectations of regulators, examiners, and their board of directors, as well as their customers, investors, fellow employees, and communities. In the era of the see-through economy, the rapid advancement and proliferation of technologies, including social media, have exposed companies to reputational and related risks. We live in an age of transparency where the public is empowered to impact a company's reputation. Without measuring any key risk indicator, the value of the company's risk management program, or the degree to which previously unidentified risks have been mitigated, is unlikely to be demonstrated. Essential risk management metrics in implementing key risk indicators. Here are some crucial top-level metrics in developing and implementing key risk indicators by companies. 1. Total number of systemic risks identified. Systemic risk identification detects areas of upstream and downstream dependencies throughout your organization, for example when one part of an organization is unknowingly causing strain on other aspects. This method also identifies areas that would benefit from centralized controls, eliminating the extra work of maintaining separate activity-level controls and increasing organizational efficiency. 2. Percentage of process areas involved in risk assessments. A business operation involves several activities. ERM is cross-functional in nature and cannot be undertaken in a silo. The same is true of risk. A risk event in one functional area also affects other functional areas within the company. Process owners own the risk managers on the risk information's completeness, timeliness, and accuracy. The more process owners are involved in risk assessments, the more accurate and forward-looking the data collected. 3. Percentage of key risks monitored. Most organizations need a greater understanding of how daily business metrics they rely on are related to the operations and processes. If a risk or activity changes, organizations cannot know how these changes will affect their metrics and risk exposure. Through risk assessments and linking risks to activities, organizations can start prioritizing what increasing risk exposures need to be monitored. Regular risk assessments enable the detection of increased threat levels and emerging risks, before they materialize. This prevents business metrics from being pushed out of tolerance. 4. Percentage of key risks mitigated. Having a sense of your overall risk coverage is essential, however, it is not nearly as valuable as knowing the scope of your organization's key risks. Because all risk assessments should be based on standardized criteria, you can determine a uniform tolerance, or cut level, throughout the organization based on resulting assessment indexes. This will help you prioritize resources, spending them on risks that need more robust coverage rather than wasting them on low-impact risks. With a tolerance level, this gap analysis will also help identify emerging risks as they rise out of tolerance. It will then become clear that current risk mitigation activities are no longer sufficient. By tracking essential risk management metrics, organizations can effectively mitigate existing risks and detect emerging risks long before they can negatively impact the organization. Conclusion. This video has discussed key risk indicators, KRIs. Key risk indicators are metrics that predict potential risks that can negatively impact businesses. Key risk indicators, KRIs, measure how risky certain activities impact business objectives. They provide early warning signals when risks, both strategic and operational, move in a direction that may prevent the achievement of KPIs. A key risk indicator, KRI, measures the likelihood that an event's combined probability and consequences will exceed the organization's risk appetite and negatively impact its success. Key risk indicators, KRIs, are critical predictors of unfavorable events that can adversely affect organizations. They monitor changes in the levels of risk exposure and contribute to the early warning signs that enable organizations to report risks, prevent crises and mitigate them in time. I hope this video is educative and beneficial to you. Please post your comments below in the comments section. If this video has been educative and beneficial, give it a thumbs up and share it with your friends. Thank you for seeing the Fadun, Risk Management of Everything videos. We love to hear from you. Please post your comments and questions in the comment section down below. If you are new here, make sure to subscribe to this channel, Fadun, Risk Management of Everything channel, and press the notification button so you can be notified when we upload new videos. Thank you.